Feeling overwhelmed by the endless options in retirement funds? You're not alone. If you're investing through a 401k and are unsure which fund to pick, the choices can be daunting. Many just want a stable investment that grows steadily without spending hours on complex research. If that sounds like you might want to consider one of the most popular options out there, the S&P 500 Index Fund. It's known for stability, simplicity, and broad diversification, but is it the right fit for you? Let's dive in and explore what this fund offers, and if it's worth adding to your portfolio. It can be challenging to navigate all the options for retirement investing. With so many funds available, it can feel overwhelming to figure out which will provide the most benefit. Many people don't have deep investment knowledge. They simply want a product that will provide the returns they need without spending hours in research. They're looking for something stable but with enough growth to help them meet their goals. One of the most commonly recommended funds for such needs is the S&P 500 Index Fund. It's often seen as a reliable indicator of the U.S. stock market's overall performance. But what exactly is the S&P 500 Index Fund? And is it a smart choice for your portfolio? Let's break it down to help you decide. What is an index and how does it work? First, let's clarify what an index is. An index is essentially a way to track the performance of a specific portion of the stock market. The S&P 500, for example, follows the performance of the 500 largest publicly traded companies in the U.S., whereas the Dow Jones Industrial Average tracks 30 of the largest blue-chip companies. Since the S&P 500 represents about 80% of the U.S. market value, it's widely viewed as the single best gauge of the stock market's health. So, when you invest in an S&P 500 index fund, you're buying into a representation of the broader U.S. economy, neither outperforming nor underperforming this segment of the market. How does an S&P 500 index fund work? An S&P 500 index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to mirror the performance of the S&P 500. It's a passive investment, meaning there's no active manager trying to beat the market. Instead, the fund automatically follows the performance of the index. This lack of active management keeps costs low. For example, Vanguard's S&P 500 index fund has an expense ratio of just 0.03% or about $300 annually per $1 million invested. When you invest in an S&P 500 index fund, you own a small portion of all 500 companies in the index. These companies can change if the S&P 500 replaces some with others based on certain criteria, such as market capitalization or liquidity. This fund provides broad diversification across various industries, with no single sector holding more than 30% of the total allocation. This balanced approach gives investors exposure to a broad spectrum of industries without needing to analyze each sector individually. You might be wondering, what makes the S&P 500 such a popular choice for so many investors? It's all about diversification and simplicity, two of the biggest advantages in any investment strategy. With exposure to 500 different companies, you get the benefits of broad market diversification without the hassle of picking individual stocks. Let's dive deeper into the sector breakdown to see how this fund achieves such a balanced spread. Sector breakdown of the S&P 500 Index Fund. The S&P 500 covers a wide range of sectors, providing exposure to almost all areas of the economy. Here's a closer look at the largest sectors within the S&P 500 and some of the top companies in each technology, the largest sector, making up around 27% of the index. This includes major players like Apple, Microsoft, and Google. Given technology's role in today's world, this sector remains crucial in our daily lives. Healthcare. With around 14% allocation, this sector includes big names like United Health Group, Amgen, and Bristol Myers Squibb. Healthcare remains essential, which makes it a relatively stable part of the index. Consumer discretionary. This accounts for about 10% of the index and includes brands like Disney, Netflix, and Starbucks. Consumer discretionary companies tend to do well when the economy is strong. Communication services. With companies like Verizon, AT&T, and Cisco, this sector represents about 9% of the index. Communication services are essential in today's connected world. Financials. Making up 8% of the index, this includes companies such as PayPal, Bank of America, and Wells Fargo. Industrials. Representing around 7%, this sector includes companies like Caterpillar, Boeing, and 3M. Industrials play a big role in the broader economy. Consumer staples. This makes up around 6% of the index and includes Procter & Gamble, Costco, and CVS. Utilities, a smaller, more stable sector at about 3%, with companies like American Electric Power Company and Eversource. Real estate, representing around 2.5%. This sector includes companies like Public Storage and Welltower. Energy. This sector, including companies such as Valero and Marathon, makes up about 2.5%. Materials. The smallest sector, comprising around 2%, with companies in chemicals, metals, and construction. Each of these sectors brings diversity to the S&P 500, helping spread risk across different areas of the economy. Technology, healthcare, and consumer discretionary are some of the largest, but you'll also find representation from industries like real estate, energy, and utilities, giving the fund a balanced composition. Pros and cons of investing in an S&P 500 index fund. Pros: low cost. The passive nature of index funds means lower management fees. The savings can be significant, especially over a long-term investment horizon. Broad diversification. With exposure to 500 companies, you gain instant diversification without the need to pick individual stocks. Simplicity index funds are easy to understand and don't require extensive market research, making them ideal for investors who prefer a straightforward approach. Cons: limited growth potential. While S&P 500 index funds provide average market returns, they may not offer the highest returns. Many growth-oriented funds, which target faster-growing companies, tend to outperform the S&P 500. No market beating. Since index funds simply follow the market, they won't exceed the market's performance. If you're hoping to beat the market, you may need to look at actively managed funds or specific growth funds that aim to outperform. Should you invest in an S&P 500 index fund? If you're looking for a stable, low-cost investment with good long-term returns, the S&P 500 index fund is a solid choice. Its broad diversification and low expense ratio make it an attractive option for many investors. However, if you're aiming for above-average returns, you might consider growth stock funds. Some funds, like the Vanguard S&P 500 Growth Fund, focus on high-growth companies within the S&P 500. With this kind of fund, you get the diversification of the S&P 500 but with a higher growth potential by focusing on faster-growing companies, particularly in the technology sector. While an S&P 500 index fund can perform well in a bull market, it might not keep up with certain growth funds over the long term. Between 2009 and 2019, the S&P 500's average return was just under 14%, which is strong. But in especially good years, like 2019, growth stock funds often outperformed, with some generating over 40% returns. However, during bear markets, aggressive growth funds can underperform as they're more volatile. So, is the S&P 500 index fund right for you? If you're seeking a stable, diversified option with a strong long-term track record, it could be a great addition to your portfolio. But if you're looking to potentially outperform the market, consider diversifying with a reliable growth stock fund. Remember, your ideal investment choice depends on factors like your age, financial goals, and risk tolerance. Final thoughts. Owning an S&P 500 index fund is a good starting point for those who want reliable exposure to the U.S. market. It's ideal for beginners or anyone who values a stable investment without the need for constant monitoring. However, if you're investing for the long term and are comfortable with a little more risk, adding a growth fund or exploring other options can create a diversified and potentially more profitable portfolio. Whether you choose the S&P 500 or decide to explore alternatives, remember that investing is about finding the right balance between stability and growth to help you reach your financial goals. Thanks for watching. My name's Mish, and I help people navigate the world of personal finance and investing. If you found this video helpful, please hit the like button and don't forget to subscribe for more content on achieving your financial dreams.